I'm Jim Lebenthal, the Chief Market Strategist at Cerity Partners and a member of our investment committee. This is our outlook on the financial markets and economy for the month of May. There are three things I'd like to talk to you about today. First, I'd like to address the skepticism about how on earth the equity market could be at all-time highs with everything going on in the world. I'd like to then follow that up with a brief explanation of how earnings are coming in and supporting the markets. And then finally, I'd like to talk about the war in Iran and its effect on the energy markets. So here we go. First, we've been hearing from many clients and colleagues a healthy dose of skepticism about the financial markets. How on earth can the equity markets be setting all-time highs? How can the currency markets and the bond markets be so stable with the war in Iran, with oil at $100 a barrel, with so many things seemingly going wrong in the world, including these ever-present concerns about private credit and artificial intelligence? Well, let's start by saying there are a number of things that are going right, particularly in the United States, where we continue to see good economic growth, partially on the back of the build-out of capital expenditure for artificial intelligence. The labor market, which for the last several months I've been saying to you is okay, is now looking like it might be starting to get good-ish. We're still seeing no signs of mass firings, and we pay attention to the weekly jobless claims to draw that conclusion. But when we look at indications of hiring from indications like the monthly labor report or the ADP weekly survey, we're starting to see that jobs are being created. We're seeing manufacturing coming back to the United States through the ISM Manufacturing Survey, which has been above 50 for each of the last 3 months, indicating that not just artificial intelligence build-out, but other industries are also bringing onshoring of their production back to the United States. We've got deregulation coming, and we've got a stable environment for the Federal Reserve, by which I mean we may not see rate cuts anytime soon, but we do have a dovish chair coming into the Federal Reserve in Kevin Warsh. So there are a lot of things that are going right to support the U.S. economy and the financial markets, but none are bigger than earnings, which really drives the equity markets. And since the beginning of this year, we have seen earnings estimates for 2026 and 2027 do nothing but go higher. You may think, well, isn't that some sort of sugar high? Isn't this just energy companies having their estimates go up as energy prices are high? And the answer is yes, that contributes, but far and away the biggest contribution is technology earnings. And on the back of technology, energy, and materials earnings growth, we have seen earnings expectations now rise to 19% year-over-year growth in the S&P 500 earnings per share. 19% is the reason why the market is setting all-time highs. It's a very high number. And for the next year, 2027, we're still looking at 16%. So all in all, earnings growth is there. Now, I said I would mention the war in Iran as the third topic. It continues. Yes, there is a ceasefire, but the Strait of Hormuz is closed, and that's keeping energy prices high, as well as putting upward pressure on things like fertilizer and helium, which is used to produce semiconductors. Putting this all together, we should expect that inflation remains higher than comfortable for the next 2 quarters at least. By higher than what we're comfortable with, we see about a 3% inflation rate through the second and third quarter. That's probably not high enough to cause the Federal Reserve to raise interest rates, but it certainly will not allow them to lower interest rates either. But looking past the next 2 quarters, we do think that we're going to see more and more diversified sources of hydrocarbons outside of the Persian Gulf. This will be a multi-year process, but we're already seeing it with increased demand for U.S. liquefied natural gas and crude oil. And we expect that will continue in the years to come, lessening the importance of the Persian Gulf and the Strait of Hormuz. We're not saying that everything is hunky-dory. We're just saying that there is a horizon in which the Persian Gulf matters less and less to the global supply chain. We'll keep you posted month by month how that plays out. Thank you for listening to me, and I look forward to updating you in another month.